Today, Jared and I will preview the auto and services sector under our coverage. Large part of these stocks fall within the consumer segment, and Alex covered off on the themes there last week. So today, given the breadth of themes in different sectors here, we're just going to make some really try to be quite brief bottom-up comments on these most topical stocks within the coverage. Last week, when I previewed my financial sector, I gave the view that I thought at the value end of the market, where some businesses can come in with better than feared results, is where we're likely to see the better positive reaction. So I had three stock announcements and results last week. To a degree, I think there's a little bit of evidence of what I'm suggesting there. BCOR pre-released their results. That came in 7% below expectations, but widely expected result miss, and that was actually up 6% on the day. Credit Corp missed expectations by 15%, so certainly not better than feared there. The stock was up about 2% over the 2 days post the result. And Pinnacle, as Macca just mentioned there, that result came in exactly in line with expectations. No change to consensus forecast in 1 or 2 years ahead. And that stock was up 9% on the day. So I guess the message isn't taking a lot to see a positive reaction from some of these names, and where it is factored in. From what I've seen so far, we're at least getting a sideways move in the share price. So that theme was the preface of adding this stock into the preview document. As you can see here on the chart, this stock is going into this result with really low expectations, a valuation point 25% below its average. So it is the preface that we put IPH in the preview document as a better than feared, as I'm describing it, result. And that's not so much that the result will be outperforming rather than the expectations are very low, and an inline result should see some share price positive move here. Result itself, the AGM comments were for the first 4 months of the year for this stock, where they suggested that the business was flat on an underlying result, so that's Asia and Australia, and that there was growth coming through acquisitions at currency. So there's been no change from what we can see in the final 2 months of the year. So the result, I think, comes in line with expectations, which is about a 9% growth for the year. Importantly, one of the pressures that the market has been wary on is the lack of growth in Australia. This result should see some improvement in the Australian result and see growth come through. So that, coupled with the low valuation, is why we put this one as a positive share price reaction in the preview document. Now, you don't get stocks, on their lows without risk. So clearly there are some risks here. And what's really going to be important is the cash flow and the result quality. One of the reasons why the share price has been under pressure over the last 6 months is the last result had some quality issues where receivables grew, past receivables also grew, and the cash flow was weak. So that's going to be a really positive factor in this result for that. So there is a little bit of risk there, but we think coming off its lows, IPH will be a share price mover on the day. Just really quickly, I can't dwell on all stocks, just IDP Education. The result itself, we actually think it'll be strong, up 20%, has some element to actually have a little positive surprise, but the composition of this result, where we have weak IELTS testing and really strong positive student placement dynamic. That student placement dynamic, the outlook is actually weakening a bit, and that was, also became exacerbated and pretty obvious when Canada put a cap on their student numbers. So ultimately, we pulled this stock back to a hold pretty recently, a couple of weeks ago, just on that outlook risk becoming a little bit deteriorated over the last 6 months, and we'd prefer to see those risks dissipate a bit before getting back on the front foot on that stock. Just moving to the auto sector, a couple of themes at play here. 2023 was a record new vehicle sales year for the auto sector of just over 1.2 million vehicle sales, surpassing the 2017 previous record. Now, when the industry talks about sales here, it really is deliveries. So cars delivered to customers that have made an order, and given that order bank and the change in the dynamic that we all know, it does reflect really more supply than demand. And as you can see on the right-hand side, supply has really improved, especially in the back half of last calendar year. We saw that come through, but it is quite variable on an OEM by OEM basis. And that has ramifications for the retailers, but also probably more ramifications for the aftermarket suppliers, which Jared will talk to with ARB and GUD. On the demand front, what we did here through the last 6 months of last year is that the fleet and novated segments have really held up strong demand. Prestige part of the market, really strong demand holding up. But where we're starting to see some weaknesses in the mass market part of the market, which is pretty logical and obvious, to be honest, what we in the market have been talking to and looking for, where that cost of living and interest rate environment will bite a bit. So that will fold through into the theme here, as we do expect orderly reductions in order books coming through for the retailers. One of the other big themes in this reporting season in the auto space, especially in the retailers, will be on the cost front. The thing that will stand out will be the cost of finance, the bailment cost. That will be flowing through pretty heavily, and I think that'll be more obvious when we look at the scale of the operators. So for an Eagers, they'll be in their numbers, but obviously there's other parts of that business where they can try to mitigate that cost pressure. That cost pressure will be more obvious when we look at Peter Warren, a smaller operator, and when you look at just where we expect earnings to be, Peter Warren down on the PCP, Eagers is a full year result, but up on the PCP. So just really quick snapshot on these stocks in terms of reporting. Eagers, we think, will be in line with consensus. That's a solid result. It's really a solid outlook. Last year, Eagers gave a revenue guidance. We expect that is potentially the case again, where the company gives revenue guidance, and ultimately we think that can be more than $1 billion again. But it's not such a heroic number, given that 700 to 800 million of that comes through an acquisition which was approved last week and should settle reasonably shortly, and obviously some positive dynamics coming through for BYD. Obviously, current demand, margin impacts, that's all going to be part of the themes. We think that sort of plays out somewhat more negatively to the smaller players. Therefore, despite valuation gaps, do have a preference for the scale operator in this space. But for Eagers in itself, I don't think the result is a huge catalyst. What we have seen for this stock is really trading in a band over the past year, with that consumer sentiment pressure, at least from a market perspective, and the sentiment towards the stock, seeing the stock trade in a band, roughly $12 to $16 through the past year. And I actually think 1 year ahead, that is probably likely to be the case again, with the stock currently in the middle point there. Just lastly, on my last two in this space before I hand to Jared, BCOR and Smart Group. We've had pretty recent recommendation changes on both these two. So Smart Group moved back to a hold at the end of last year, and BCOR very recently upgraded to an add recommendation. Now, just on BCOR, it's not the easiest investment case here. We have been avoiding and I guess talking to the pressures we see through BCOR over the past 2 years, and really on the sideline looking for the right point to take on exposure to BCOR. So last week, we actually upgraded the stock, and the preface there was really that the downgrade came through. We had a better understanding of the base earnings, and that was washed out. And when we look 1 year forward ahead, although you're taking on some earnings risk, we now had a better understanding of the base and the valuation point allowed for that. In FY25, earnings should be going up. The quantum might be debatable, but earnings should be going up, not down from that point. So that was the preface of the upgrade. Since that point, we have had a CEO change. So it does add a little bit of more complex dynamics to this investment case. The stock went up on the back of the CEO change. The market has been looking for change in this business, and we've got it at the management level. There is a few problems there. There's been a lot of turnover at the executive level in this business. The new CEO comes with an extremely positive sort of CV and track record in this space, having led Total Tools out of Metcash for the last 5 years, and before that was within Burson. So I think the market will have a warm reception to that experience, especially in retail where BCOR needs some improvement. On the negative, this does now come with a rebasing risk. We think the efficiency program targets will be stepped away from. Part of our sort of upgrade was we thought they would be reduced and the market could take that positively. We think they'll be fully stepped away from now, which will just add less certainty into the outlook for BCOR. So although we still think it's cheap enough here, just recognising that there's that rebasing risk in the business. Probably suggests it's more an accumulate than an outright buy, and it's cheap. Take a 2-year view. We think it'll be going higher. The next 6 months will be tricky with the new CEO appointment. And just on Smart Group, really quickly, for those that have owned it, we think there is a special dividend that's possible in this half. There's probably a little bit counter consensus. We did pull it back on a valuation. This outlook's really strong. We think the valuation reflects it here, and we're probably looking for a better entry point into this stock and some more clarity on the high cost growth that has come through the business on the last 6 months. So I'll just pass to Jared. Thank you.
Thanks, Scott. Further to Scott's opening comments, so I've included a couple of charts on the next slide that illustrate some of the business-specific impacts that ARB and GED are specifically feeling from this macro new car supply unwind that we're seeing. So clearly, chart on the right, wait times are down on key models. I've got just the top 10 average models there, as well as the Ranger and Hilux volumes, which are key sort of models for both ARB and GED. And as you can see, we're nearly back to pre-COVID levels there, and the trend is clearly in his favour, and this unwind is having a direct impact as these businesses are now, in terms of their targeted models, are clearly outperforming system growth. So just on the stock-specific comments, you may recall that we recently initiated on GD in December last year with an ad recommendation. We still like the stock going into the result. Its first quarter trading update was reasonably solid, just very strong APG recovery, solid core automotive trading, and a few challenges in NZ, but a smaller part of the business. We like GED. It's generally given. We like GED given its generally resilient earnings base, entrenched market positioning, clear near-term leverage to the new vehicle supply unwind, and long-term organic and inorganic growth levers. As we all know, the vehicle supply constraints are varied at the OEM level, but this variability is clearly shifting into GED's favour. Just for example, half on half new car growth, GED's targeted index volumes are up 20% versus market up 10%. Some meaningful outperformance there. But while we don't expect this to be a clear sort of direct correlation to the earnings, we do expect to see meaningful evidence of this flowing through to earnings at the FY25 at the result, and continue to build a base for further growth into FY25. Just in terms of valuation, I think it's very undemanding. It screens too cheap, and we have a high degree of confidence in the earnings of this business relative to peers. If I just look at the 12.5 forward multiple, 11% EPS growth, and I think there's upside risks in terms of the APG recovery. I think it's a pretty good place to be given the near-term earnings visibility and certainty that you're getting, as well as strong tailwinds both in the near and long term. Just on ARB, extremely high-quality business, pristine balance sheet, but one we've had on a hold since initiation just due to larger earnings uncertainty and a premium valuation. Without saying the obvious, relative to GED and Bapcor, we view ARB as far more exposed to the consumer backdrop and just cautious on this dynamic should sales growth slow or stagnate. While these impacts haven't been felt yet in the domestic market, which has been quite strong or reasonably solid in the last 12 months, we have seen ongoing weakness in some of the ARB's offshore channels, particularly within the export division and within the US specifically. And while I've maybe harped on the US, it's a reason it's a key focus for us, is given the investments ARB is putting into this market, as well as the long-term growth it's supposed to drive through a branded store network. So just going into the result, a little bit cautious that potentially some further instability going into this channel, which just has us waiting for greater evidence in this investment case. While we know it's only a small portion, 12 to 15% of the business, it does represent the longer-term view of the stock. And just given the premium valuation, 26 times aligns with a medium-term average, 2.5% free cash flow yield, and relatively modest EPS growth of only 10%, we prefer just to wait on this name for greater earnings certainty before we're looking to take a more positive view. Potential upside risk to our forecast would be meaningful orders in terms of the Earth Camper, the new product that they released or announced last year, as well as meaningful execution of the US rollout.